Hey, how are you? I'm Duncan McPherson and welcome back to my channel. Today I'm going to talk to you about how we handle things in Canada. When you as a non-resident, say an American, must file a personal tax return up here. I'm going to warn you though that after this video, you may conclude that we Canadians are not as polite as you first thought. I'll admit it's a bit of a hassle, so listen up on how to reduce your aggravation. And for more information on non-resident compliance, please check me out at themactax.com. And don't forget to subscribe for more tips on navigating the Canadian tax system and to avoid all the BS you're probably already experiencing. So before we begin, please take note that a Canadian 1040 is known as a T1 personal tax return up here, or T1 for short. And when in the USA, a Canadian earns any of the following: business income, employment income, capital gains, this is all handled on a 1040 NR in the USA. But here in Canada, you as a non-resident are going to have to file 3 different types of returns depending on the type of income. And it is a quagmire at times. And now I'm going to walk you through these 3 types of returns. Your first type of non-resident return is a Section 216 tax return. This one is used only to report your real property rental income. No other form of income goes on this type of return. Please take note that, and I am really serious here, there are absurd compliance issues when a non-resident earns real property rental income in Canada. It is completely out of the park compared to the way the US handles it. So to get a better understanding of all this nonsense, make sure you watch my next video. Rental income and the sale of real estate by a non-resident of Canada. You'll be very happy that you did. So for now, just note on your 216 return, we only report rental income. And if you have multiple properties, you can throw them all on there as one single return. You don't have to file multiple returns for multiple properties. One return for all your Canadian rental properties. Also, do not forget, your 216 return is due June 30th, unless you sold the property in the year, in which case it is due April 30th. And I assure you, you want to get it done by April 30th, or you're going to have penalties coming out your yin yang. Again, see my next video for details on this. And again, you'll be really glad that you did. So that's the first return. The second type of non-resident T1 is what we call a Section 115 tax return. On your 115 return, you as a non-resident would report the following forms of income: employment income, business income, self-employment income, the sale of Canadian real estate, oh yes, and or the sale of a Canadian business. Those would all get reported on a 115 return. And this return is due June 30th of the year following the year in which you earned the income or sold the property and earned the gain. Now, if you earn employment income in Canada, you will receive the Canadian equivalent of a W-2, what we call a T4 slip. And if your business or self-employment income is treaty protected so that you don't have to pay tax in Canada, you still must file the 115 return and claim treaty protection, exactly what a non-resident of the United States would have to do in the USA on a 1040 NR. Also, I'm repeating this and I'm repeating it again for good reason. The sale of real estate in Canada by a non-resident gets reported on a 115 tax return. And you can't tell it from here, but there are a lot of traps and pitfalls from non-residents selling Canadian real property. I haven't even touched on them in this video, and it's a fucking hornet's nest. So because it's beyond the scope of this video, I'm going to delve into it more in my next video: rental income and the sale of real property in Canada by non-residents. I implore you to watch that video. If you had some other esoteric forms of income, they would also be reported on a 115 return, like the sale of an income interest in a Canadian trust. But the ones I've highlighted above are the ones that you are most likely to encounter. I will venture to say that the 5 or 6 types of income that we've mentioned in this video are what you will encounter more than 95% of the time in your practice or in your real life. So just a quick recap. If you were to earn employment income and rental income in Canada, you'd be filing 2 returns. You'd be filing a Section 115 return to report the employment income and a Section 216 return to report the rental income. And here's some useless information for you. Both the 115 and the 216 return are actually the same form. You just check off on page 1 whether it's a 115 return or a 216 return. It's useless information, but can help you organize your thoughts a bit when you're wondering what the return itself looks like. You can go online and download it if you want. And if you're unsure if you have Canadian source taxable income, contact me at themactax.com and we'll hash it out together. Now, the third and final type of non-resident return we are going to discuss is the recovery of over-withholding. The funny thing is, it's not even a return, it's a form. So if someone unkindly over-withheld on you, you have 2 years to file this form and claim back the over-withholding. If CRA disagrees with you, they will issue you a notice of assessment. This gives you the opportunity to object and appeal CRA's determination that you were not entitled to the withholding. It's actually a pretty friendly process, but it's just a little bit awkward to navigate. So give me a call and I'll help you do it. Okay, so that's the quick and dirty on how non-residents are taxed in Canada. But just to let you know, there are actually 2 other types of returns that could require to be filed by non-residents, but are so esoteric and they happen so seldom, I did not think it was worthwhile putting them in this video. It would have made it too awkward and too long and too boring, so I just left them out, okay? And just for your own reference, one is for actors and actresses, and this applies only in very limited circumstances. And the quick and dirty of it is the circumstances when this actor or actress also has their own production company, but I'm going to leave it at that. The other is if you elect to be taxed as a Canadian resident instead of a non-resident. But again, this applies only in very limited circumstances, and most of the time, and 99% of the time, it's when the non-resident is receiving various forms of Canadian pension income. But hey, if you think either of these apply to you, give me a call and we'll talk about it. No problem. But as you probably already guessed, these are so uncommon, it is why I left them out of this video in the first place. I just didn't want you to think I was holding out on you. And before we go, just a few quirks on the aforementioned. Accountants love the word aforementioned for some reason. Suppose you have a rental property in Canada where you have been reporting your rental income and expenses for a few years, and you're of course taking depreciation. And now in year 5 or 6, you've sold the property. So boom, you're going to have a capital gain and recapture. Well, how's this going to work out? The capital gain is going to get reported on your 115 return, but the recapture will be reported on your 216 return. I know that sounds crazy, but that's how we do it up here. And the last thing I'm going to mention today, and listen up because it's a big one, and I am not you. You've got to listen to this one. Okay? If you have a property in Canada, a personal use property or vacation property, say it's a chalet in Alberta and you've owned it for a few years and you've decided that you're going to sell it. Before you sell it, you must get a Canadian tax ID number. Before you even fucking list it, get a Canadian tax ID number because you are going to have problems coming out your yin-yang if you don't. Problem number 1, if you do not have a Canadian tax ID number, you will be withheld on the gross sales price instead of the net sales price because you do not have a tax ID number to apply for withholding on the net gain as opposed to the gross selling price. There's problem number 1. Problem number 2, if the withholding gets remitted to CRA without a tax ID number sitting beside it, it can become agonizing getting CRA to track down your withholding tax for when you file your tax return to claim back the over-withholding. Here's my advice, and please take it to heart. If you own Canadian real estate, whether it's a personal use property or rental property, I don't care how long you've owned it, I don't care how long you plan to own it, as soon as you own it, go get yourself a Canadian tax ID number. It is not that difficult to do. You are going to save yourself months, weeks, months, years of agonizing horse if you get yourself one before you need it. If you're going to wait till you get it when you need it, you are just going to be going through agony. So please take my advice here. If you've got Canadian real estate, go get yourself a Canadian tax ID number. Because if you wait until you need it, you're going to regret it. And to avoid that regret or any other issues regarding your personal filings here in Canada, contact me at themactax.com to help you avoid these hassles. Or better yet, just click on the link below. We can work it together. And I thank you for watching, and I'll see you on the next video, which I mentioned earlier you can't afford to miss. Take care, and I'll see you then.